Welcome to today's podcast. We've got an exciting case study lined up for our listeners. Georgia reached out to Dave's team because she's starting to feel the strain of managing her two investment properties, and she's looking to create a property plan to guide her decisions over the rest of her working years, ensuring that she can enjoy a comfortable retirement and enhance her lifestyle right now. It's a situation that many of us can relate to, particularly in this climate, so let's dive in. Georgia is currently 52 years old, no children, living in Sydney, renting and working 4 days a week. She owns two investment properties, one in Pagewood in Sydney's east and the other in St Leonards on the lower North Shore. Together, these properties are worth around $2.86 million and they bring in a gross rental income of $82,000 a year. Her plan has always been to eventually move into the Pagewood property, but she's not sure when she'll be able to do that. This was a key question that she wanted us to answer. The Pagewood home has a lovely garden, but it's going to need a lot of upkeep, something that might be challenging for Georgia as she gets older. So while she's thinking of moving to Pagewood for a while, she's also aware that at some point she'll need to downsize to something more manageable. Dave, why don't you kick things off by giving us a bit more detail on the key questions Georgia wanted to address in her property plan and the concerns she has?
Yeah, so Georgia, if we start off with Georgia's concerns, one is she actually doesn't have any borrowing capacity, which has happened to a lot of people who bought property while rates were really low, and now they've obviously risen a lot. So she's stuck. She can't refinance, and she's on principal and interest repayments with her debts, and she's gotten to a place where she's basically not able to save any money. And so she's quite stressed about her cash flow, and that's sort of keeping her up at night at the moment. So that change in interest rates and then repayments has actually cost her an extra $3,100 per month. And as you said in the intro, I think this is happening to more people than probably we realise across the country. And I think that big sort of savings buffer that we built up through COVID is starting to dwindle down for a lot of people. That's what's happening with Georgia, although she does still have that big offset, that big savings balance. So she still has $285,000 in savings, but, she is in her early 50s. She's not that far away from retirement. And, so that's playing on her mind. So some of her questions include, can I manage to hold both of the properties? If I can, for how long? Will my cash flow improve in the long run if I hold tight and keep going this way? And what will my long-term outcomes be if I hold on? And is it worth the mental anguish and financial stress that I'm going through at the moment? Or, should I consider selling?
Yeah, poor thing. It's not an uncommon thing at the moment, as I said earlier. Interest rate increases were so dramatic, and despite the fact that some of us that have been in the industry for a long time can say that they're at historical normal levels, it doesn't feel like that for someone whose new norm was 3% or 2.5%, let alone 2%. So I do feel for Georgia. Dave, were there any other critical elements that needed to be considered as part of her plan?
Yeah, so look, she wanted to ascertain the property performance and as I touched on, model out a potential sale. Now, looking at St Leonards, which she's owned for 12 years, it's only had a capital growth rate over that period of time of 3.1%. So it's certainly underperformed. Pagewood is also the property that she plans to live in. So there's an emotional connection to that property, even though she's renting at the moment. And this also has had stronger capital growth, albeit over just a shorter period of time of 4 years, but it's grown at 8.5%. It's a great example of, purchasing a more valuable property when you get the capital growth. She's grown equity of $500K just in those last 4 years, which anyone would be happy about, wouldn't they, Mike?
Yeah, that's fine. Again, like we talked previous weeks about when a property can replace your income, and that's kind of like there's another salary in the household there.
So, Dave, we've identified some of the key elements and questions in the plan. Can you talk us through the timing for Georgia?
Yeah, so Georgia, another key element she wanted to build into the plan. That's a great question, by the way, Kate. She would like to scale back work in about 5 years, and she is currently working 4 days a week and would ideally like to go back to 3 days a week when she's 57. And she'd like to ideally retire when she's 60 if she could, which is in 2032. So 8 years' time from now. We've already touched on that predicament that she has in terms of the cash flow pressures and the stress around that. So, so look, we're going to work through that as we work through her plan.
Mike, why do you think setting goals and creating a plan and a roadmap to achieve them is so important on our property journey?
Well, I think without an idea of the destination, then you're just kind of running around with no real purpose. It's like lining up to the 100 meters at the Olympics and not pointing in the right direction. You could go all sorts of places fast, but you're not going to win the race. I've sort of said it over and over again. I equate it to the sort of like the dessert and veggies model. Like as a kid, like you can't have your dessert until you eat your veggies. And I think the dessert is the buying the properties, right? But the veggies are the plan. And without the plan, you're going to die of scurvy or whatever happens to people that don't eat their veggies. So, yeah, look, you've got to have a roadmap of where you want to get, because then everything becomes subservient to that roadmap.
I love your analogies. All right. Well, once you've set your goals, you can then reverse engineer a plan via the property planning software and model out various pathways to achieve them. A precursor to this is understanding the financial position of Georgia. So, Mike, can you share that with our listeners?
It's going to be a bit number heavy, but strap yourself in. Let's start with income. 175K a year is Georgia's income. Her passive rental income is 82,000 gross. Net cash flow on properties is negative 83,600, meaning her repayments and holding costs are 165,600. So for cash flow and savings, her living expenses are 3,500 a month. She's paying 1,300 a month living with girlfriends, and monthly savings of naught per month, hence some of her sort of stress at the moment, not saving like she would like to. Although her total available savings are 285K, which is pretty healthy. A good super balance of 380K, nothing to speak of in other investments. So with property number one, the investment property in Pagewood, she bought that in 2020. It's now worth 1.96 with 1.238 of debt. So just over 700K of equity. It's a midterm home. The plan is to move in, but then downsize eventually. It's currently on a principal and interest at 7.6% as she stretched her borrowing capacity to purchase the property when rates were low. And this is putting significant strain on her cash flow, obviously. Property number two is the investment at St Leonards. It was bought in 2012. It's worth 900K. She has 365K of debt and quite a lot of equity at 535 in that one as well. So the overall property value and equity, so the property value sits at 2.86. Total debt is 1.6. So the total equity in the portfolio is 1.257, which is an LVR of 56%.
It's a healthy LVR.
Yeah, it's solid. Yeah, there's room to move. So I'm looking forward to seeing Dave massage the numbers and come up with a very good plan for her. There's certainly options available. So if we summarize, despite wanting to scale back at 57 and retire at the age of 60, which is, it probably needs to be said, that's quite young in today's environment. The government wants to keep ratcheting that up, but it's only 8 years away. So from an initial assessment, you can see that she has a few things in her favour for achieving her goals: a good income, no dependents, good savings balance, good money management habits as her expenses are fairly well managed, and excellent equity of 1.25 across those two properties. The super balance is solid as well, and she's got a good income. So Dave, a bit to work with.
Yeah, and she also is open to downsizing her Pagewood home as well at some point. So that provides the opportunity for the downsizer contribution which you can do when you downsize a home and put it into your superannuation, where you must be older than 55. So she'll tick that box. You do need to have lived in the home for at least 10 years before the sale. So that might be a challenge for her. For it to qualify as a primary residence. It's capped at $300,000 per person. So, that's a consideration for her as well. But even if she can't do that super downsizer contribution, it just is another string to her bow, if you like, to help fund her retirement.
Yeah. Dave, I understand that Georgia was considering selling one of her properties to help her with her cash flow. Can you walk us through that approach with her regarding this decision?
Yeah, sure. So the first thing we did was model Georgia's current situation out to retirement and just get a clear picture of the likely outcomes over the next several years and beyond into retirement without making any changes. The big question was, could she keep both properties and improve her cash flow? But what we found, while her cash flow would improve, it would only improve by a marginal amount, about $80 per month indexed. So it wasn't enough to relieve Georgia's concerns about the stress of carrying the debt and having the weaker cash flow. So she came, and because she's also hampered by the borrowing capacity and unable to refinance, the higher loan repayments, she came to the decision to sell. Basically, and not Pagewood, because it's obviously performed better, and she has that set up as a future home. So she decided to sell St Leonards, and she felt really empowered by being able to make that decision through the modelling and, with, I guess, a level of awareness that most people don't have. Now, by selling St Leonards, she's actually able to improve her cash flow by around $12,600 per year, which is reasonable. But then also by refinancing her loan and moving it on to interest only, that would get her savings of another $1,600 per month. So even greater than the cash flow benefit of selling St Leonards. Further to that, she'd now walk away with an extra $540,000, which means she now has over $800,000 in offset. And because if you're on interest-only payments, the offset balance actually reduces your repayments, whereas if you're on principal and interest, it reduces the interest, but your monthly repayment stays the same. She actually reduces her repayments by a further $3,900 per month. So all of a sudden she's gone, well, she will go once it's sold and she makes those steps. She's going from someone who's under real cash flow pressure to someone who will have extra savings of about $78,000 a year, $6,500 a month, and she's going to have over $800,000 in her offset account.
Life-changing. I just love this scenario, and I feel really sad for Georgia that she had sleepless nights and stress about this, and that she's feeling guilty about the decision to sell, because she purchased this property purely to give her an outcome this valuable. And I look at the timing here. She purchased St Leonards back in 2012. So this has been a good hold. She's held it for 12 years. I say to everyone, if you haven't got at least a 5-year timeline in mind, I don't want to work with you. And if you think that less than 10 years is long-term, it's not. Well, ideally, I would love to see Georgia have this for 20 or 25 years, but she did this to free up her options into retirement and leading up to that time. And it's doing exactly that. I think it's very powerful. And, the value now is $900,000. The equity is $535,000, and you've just highlighted what it means for her lifestyle. And it means she doesn't have to work as hard as she's working as well. That was one of the points she wanted to talk about. So I think it's incredible. Mike?
Yeah, look, it's a great example, and we haven't done many like this. That's one of the reasons I love this scenario. It's not necessarily how many, buy 3 or 4 or 5 properties and this is what it looks like at retirement. It's, I've got 8 to 12 years till I retire, and I'm in a bit of a tough situation at the moment, and what are some decisions I can make? It's actually probably just about this one as it unravels my favourite one we've done out of all the case
Yeah,
studies.
I love it because she's obviously reluctant to sell. Every investor is, but you've got to remember it was an investment. You did something to build your financial future, and now's the time for her to start to realise that.
Yeah.
Mike, many people don't know what their future financial position will look like, and in particular the cash flow before or after they purchase or sell a property. And many property advisors don't really get into the nitty-gritty of these numbers with property buyers. Why do you think people are willing to make such big decisions without doing the appropriate due diligence, and why do they go off gut feel?
It's a bit of a mystery why people are quite happy to make such big decisions so poorly researched, right? There's a fair argument to say we're more likely to spend more time researching our next television than we are our investment portfolio and the strategy around it, I think many advisors don't necessarily understand the costs involved. You can look at, okay, what would the interest and, let's say, principal repayments be? What's the rent going to be? But don't necessarily go to the nth degree with property management expenses, after-tax expenses, the maintenance and the managing of the property. Residential property investors don't do life cycle costing exercises like in a unit complex that might have a sinking fund. Like, often that can help as well. And that's another thing that people don't factor in. If it is strata titled, those expenses and special levies can pop up. I think the fact that 72.5% of investors only ever own one property is evidence that we often get that wrong, and we don't forecast those expenses at the beginning and put ourselves in a position where we're forced to sell. And I think, Kate, you made an interesting point about, interest rates might be in and around their historical levels, but the pace of change in interest rates was unprecedented. We've never seen interest rates rise as rapidly as they have. So that's a very difficult one when you throw that in the mix when we're talking about an already kind of underprepared investor base that don't do that analysis and often don't have advisors to walk them through that as well.
Yeah, that's so true.
I think the big one is most people don't take, and we see this firsthand every day, don't take the time to actually know their living expenses. That is actually at the heart of so much of actually being able to understand. Now, there's also obviously a lot of complexity then around working out, okay, well, what are my goals going to be, after I settle on the property? What is my position prior to settling on the property? What are the tax implications? How do LVRs change, etc. But a lot of people actually don't really know their living expenses and don't take the time to actually work that out and get a clear number around it. So that's sort of the nub of a lot of the reason why people don't crunch these numbers, let alone, lots of purported property advisors don't.
And you know what? I'm going to sound harsh here, but there's no excuse. 20 years ago, you'd put all of your payments and every receipt, every note, every post-it into a shoebox and count them at the end of the month. That was the rudimentary, very manual way of doing it. These days, you just have to coordinate yourself on your banking page, your personalised online statement, and work out where all your money's going. And I think it's laziness or fear when people don't want to know what they're spending their money on, because we're not a cash economy anymore. You can track everything.
And there's an app for that, right? You can have third-party apps that your income and your expenses go through, and it'll give you a nice little pie chart of where you're spending all your money. I don't use them because I'd be horrified by the results.
I think that's why people don't like paying attention. They're fearful. They know what they don't want to know.
And one thing that I think people don't necessarily consider is that life doesn't always go to plan. You could lose your job, you could be made redundant, you could be sick. I mean, as a construction estimator, we always have contingencies in the mix, and I don't think people build those contingencies and those safety buffers into these estimates. They always think of a a glass half full approach. And we're sort of trained to fill out these household expenses thing, from the banks and the broker side. It's like, what's the absolute minimum I could justify to get this loan to float? But when you're doing it for yourself, you need to be realistic on what your expenses are. And, often that's a worthwhile exercise to uncover where you might be going wrong, because there's all sorts of things that we can blow money on. I mean, if you've ever done one of those audits to look at what are the apps that are coming out as a debit each month, it's it'll stun you rigid.
Yeah, I mean, you almost always, if you go back over the previous 12 months, you can find areas where you can improve your spending habits, and it can be a motivating factor to do so.
Totally. Which segues nicely into my next question, because we're all chatting about our approach to money, and with that comes a bit of risk profile. Let's talk about George's risk profile, Dave, because you capture that data. What does George's look like?
Yeah, look, I think we can. She is it too. She's She's conservative, and I think that comes through with how she's feeling about the cash flow stresses and the wanting to sell one of the properties. So, and felt like the team felt like that was appropriate assessment for her. We've talked about this, Kate, before. What are your thoughts?
Yeah. I'll look at it as a very unfair snapshot, because I've breezed in and seen 10 pages of information and output on George's scenario, but I would agree. And the thing that takes me back to that point is, firstly, she's been conscientious and this has kept her up at night. Someone who's got a really strong tolerance for risk and is excited by it won't be up at night freaking out. They'll be up at night excited and planning the next risky thing. So that's already an insight. I also look at her overall cash flow and savings and investment position, and that is a very telling position. She's got savings, $285,000 worth, which is a lot. And, when someone pops that away, under the mattress, that is a little bit of an insight into their personality as well and their approach to risk. Her super balance is sound, and, she's been very dedicated and regimented with managing all of this, and she's reached out when it's felt like it's getting a bit untenable. So all of that says to me that she's conservative and sensible, and very much in control of understanding the implications of these things, because it sounds like what you resolved, she completely understood straight away that it was a really good option.
Yeah.
Dave, in terms of building out the property plan, what were some of the key assumptions that were built into the plan? The assumptions are obviously so important to the outcome, so it's important that she's being conservative and realistic. Would you agree?
Yeah, 100%. So with Pagewood, we've modelled capital growth of 5%. Now it has grown at 8.5% since she's owned it, but we did find a sale of the property in 1994 for $396,000. So the actual modelling out the capital growth from that data point, which is obviously more reliable over that long 30-year period, its capital growth has been about 5.45%. So, 5% was the right number there. Some of the other assumptions we include is interest rate at 6%, inflation 3%, occupancy rate 92%, rental yield 3%, rental increasing at the same rate as capital growth 5%. So many people don't think about this, but if you don't model the rent increasing at the same rate as the capital growth, you just have an ever diminishing yield, which is a bit ridiculous because that isn't what happens in the real world. And so this also intersects with the idea that if you have a property that provides greater capital growth, you're also likely to get greater growth in rent, even though the yield often will be lower. So again, that's that point. Probably touched on a fair bit lately. Which is a tricky concept.
Yeah.
And wage growth of 3%.
Yeah, look, they all sound reasonably fair to me. In fact, I'd say they're conservative, which I know you pride yourself on. An occupancy rate in this climate of 92%, I don't agree with that one. I think it's far tighter. But Mike, do you have any?
No, it's
any
very
comments?
conservative, 92%, isn't it?
Yeah.
Keeping in mind, these are all modelled out until retirement. So it's not just this climate, this 1 year. It's like that's for the whole through to age 65.
Yeah, but even in some of the area, well, I've obviously not targeted vacancy rate issue locations in my history, but through all of the different cycles that we've been through, I've never had an 8% vacancy rate hit me.
Yeah.
Other than in the middle of COVID in Melbourne.
Yeah.
I think I think the occupancy rate. She did mention she was worried about development in the area, which may reduce the desirability of the property, or let's say scarcity of the property. So I think it's good that there is a little bit of an extra vacancy rate in the mix, but I still think it's super conservative. But that's a good thing. We talked about that on the show recently. It's better to under-promise and over-deliver. And, you run any of these plans, you realise that a percentage here and there, if over a big time horizon, it's ridiculous how much it can change. So it's important. There would be no shortage of property people in Australia that would just go, look, assuming capital growth of 8%, and then everyone's a billionaire over a 30-year time horizon. It's not exactly helpful. But a point that I wanted to bring up that I think kind of cements the fact that the St Leonards property was the right decision to sell was the capital growth that it was getting at 3.1% as opposed to the 8.5 for Pagewood. And we've kind of factored in a growth rate of, what are we saying here, 5%? So
5% on Pagewood.
Yeah, exactly. So it just goes to show St Leonards was really underperforming, and I think 5% capital growth in Pagewood is going to be relatively conservative over the long time frame as well.
Yeah. Well, let's dive into the scenarios that were modelled. I believe that there were 3 stages of modelling with many smaller decisions made along the way. Can you give us a bit of an overview, Dave?
Yeah, sure. So the immediate decisions that Georgia needed to make were sell St Leonards, refinance the Pagewood loans to interest only onto a better rate with the offset account attached. And that obviously had an amazing difference to her cash flow and financial position. So we then she would remain renting and Pagewood would remain an investment period. And we basically trialled different scenarios. We trialled, okay, what about if you move into Pagewood in 1 year? Then we modelled out if you moved in 3 years, which was sort of what she was hoping. But what we found was if we waited for about 5 years, she would then 100% offset her loan. So basically be debt-free in essence. Yeah. So we took that approach as the sort of preferred outcome, and she was open to, she's enjoying living with her girlfriends and renting, and so but it's also the advantage of being able to model out different scenarios and also tweak with elements of the modeling as well. So so we had that as an outcome, and at that point in time she'd have over $1 million in the bank. And it's also, she's actually significantly better off while she's renting, because the cash flow is much better for renting while she rents for a longer period of time. Yeah,
I love that scenario, and the key thing there was that she's not in a hurry to move into Pagewood, so that gave her a really good ability to look at it from afar without feeling time pressure. Now,
and she's able to assess, okay, here's what it looks like at 1 year, here's what it looks like at 3 years, here's what it looks like at 5 years. And, she might move in sooner, but at least she knows how things will be different.
Yeah, absolutely. So we'll move to stage or scenario 2. With the sale of St Leonards, did Georgia consider making any other investments?
Yeah, she did. We modelled the idea of whether she could purchase another investment property at obviously a lower price point that wouldn't impact her cash flow, and now that she's got into this better financial position. But at the end of the day, she wasn't comfortable with that. And although it might have been achievable, it was outside of her comfort zone, and also probably given her stage of life, being closer to retirement. So, by taking this approach, and having that extra set $70,000 a year in savings, she can now focus on putting potentially, her maximum amount into super each year, and really start to build up her superannuation. And if she wanted to do some other investing, outside of super, potentially bite-sized chunks with like shares and ETFs will be a better option for her given her risk profile and stage of life.
Okay, so one of the last key questions is how long would she continue to work and when might she scale back and to what degree? How did you approach this one, Dave?
Yeah, so her ideal world was scaling back from 4 days to 3 days in 5 years and then full retirement in 8 years' time. So what we started was modelling going back to 3 days a week, and we landed on starting this in 5 years' time, which was also when, if you recall, she moved back into Pagewood and have it around 100% offset. So look, that looked pretty good for her, and full retirement at age 60, and she would just be in negative cash flow if she did that at that point in time. She would have a strong super balance though, of 630,000, and assuming she's drawing down on that at a 5% pension, that would be an income of about 31,000 per annum. So she could also have a government pension potentially to supplement that. She also, which we haven't really touched on yet, but she is expecting an inheritance at some point, which would also help out, obviously, the picture. But we don't want to factor that in because she hasn't received it yet. And obviously these things can change, but that would be a sum of $800,000. Yeah. And she still has that option to downsize the home as well, and free up extra cash flow. So given the flexibility of work and focus on lifestyle outcomes was high for Georgia, there was a desire on her part to map out when the scale back and what the scale back and retirement looked like. This was more important to her than the question of when she moved into Pagewood, or complete the downsize after that. So the team modelled these numbers first because that was a top priority for her, which is also a good reminder of, everyone has different priorities, and so we need to tailor what we're modelling out relevant to what are the priorities for the individuals or couples.
Yeah, of course. Mike, how are we going so far for Georgia?
Yeah, look, she's in a pretty handy position. Obviously, the risk profile kind of dictates the moves that she makes. I think we're in a bit more of a defensive kind of, she's had the stress of the situation that she was in, and her appetite is diminished. But I mean, a little bit of free living with her cash flow position, she might decide to make a change to that, because there is still an opportunity to purchase an investment, and it can be a lot cheaper than the properties that she's held in the past. But there's a huge opportunity to make some voluntary contributions into super along the way as well, because she is in that positive cash flow position, and there's not much that beats super from a tax environment. The one caveat is, gosh, the federal government seem to want to play with it every 5 seconds, so that makes it hard as well, especially when you're modelling it out. And that's one of the big issues that has faced investors across super and property investing, is that tinkering around the edges is very difficult for people to manage when they're talking about 10 and 20-year time horizons. But no, I'm liking this. She's in a good situation, and there's plenty of room to tweak the plan if she changes her mind.
Yeah, I think so too. So let's move on to scenario 3. The final step in the plan was considering when Georgia should sell Pagewood and purchase the new downsizer home. Dave?
Yeah, so the team looked at two options for when to sell Pagewood and downsize. One was 2028, so one was in 2028, and that aligned loosely with her scale back to 3 days per week. once she was close to fully offset. And the other was move into it after 5 years. So we looked at two options. One was to sell Pagewood and downsize after 3 years, which was in 2028, as she was approaching being fully offset on the loan. And the other was actually waiting right out until 2035.
7 years later.
Yeah, so a lot longer later. And then basically, long story short, what we found was if she sold in 2035, she was just in a much stronger overall financial position. So without going into too much of the numbers, it just meant that she had a lot more cash left over after selling. Her super balance is now up at $1 million. And if she bought a property in today's dollars worth 1.5 million, she can still get a decent quality property, but has had more time for a financial position to improve over that period of time. So selling in around 10 or 11 years from today worked out quite well for her. Actually, sorry, one other point was then it would take her another 11 years after that to exhaust her savings before she had to live off super. So she'd actually get right out to 2046 and her age would be, I think, 74 before she actually needed to start tapping into her superannuation to live off it.
Which is very healthy by that time as well. It would have grown to over $2 million, which is an enormous balance. Even in today's dollars, it's well over $1 million. And, she could draw $106,000 per year, which is 56 per annum in today's dollars, and that's a really attractive income for someone who's got unencumbered property.
100%. And so it's a great example, isn't it, of the transition. She's selling St Leonards, which she's owned for 12 years. She's then staying renting until she's 100% offset her home. She's then moving into that home. She's then holding it and selling it in about another 6 or 7 years after moving into it. So lives in it for about 6 or 7 years, sells, downsizes, gets more cash again at that point in time, and then is able to live off her cash until she's about 74. And during this time of selling St Leonards until retirement, she's putting a lot of money into her super. And then she doesn't even need to live off her super until she's in her mid-70s.
Great. So for the third round of modelling, you explored a couple of different timelines for Georgia selling a Pagewood property. In the end, she decided to wait until 2035 to sell for a couple of reasons. One was lifestyle and one was financial. It's nice to see both elements ticked off. With lifestyle, by selling in 2035, it meant Georgia was able to live at the Pagewood property, which she's very fond of, for 6 years. And when the time was right, she could make the move to a property that required less upkeep. Financially, as Georgia was selling the higher priced property and downsizing to a lower cost property, the future value of the downsizer didn't get away from Georgia, as can happen when upgrading, or what do they call it, right-sizing. The future value of the downsizer enabled her to make that move. It meant that she achieved greater growth in value on Pagewood than the value of her future home growth, leaving her with a stronger savings balance following that settlement. Additionally, we can see George is able to downsize a home in 2035 and take on no debt for the new purchase, whereas in 2029, an LVR, loan-to-value ratio of 40% was modelled for the new principal place of residence. So, in summary, based on that scenario, at 57, age 57 in 2029, she can go down to 3 days per week. She'll have $1.155 million in cash savings, offsetting Pagewood. She'll be saving over $5,000 per month. And at age 60 in 2032, when Georgia retires, she'll have $1.266 million in cash savings. So it's $1 million worth in today's dollars. That will offset Pagewood. She'll be saving about $6,000 a month, which is $4,750 in today's dollars. And then right before retirement, at 63, in 2035, by selling Pagewood and purchasing a new property, she'll have $693,000 in cash savings, which is $500,000 in today's money, a super balance just over $1 million, and her cash savings will have dropped significantly given the proceeds after clearing the debts. As we've modelled, there'll be no debt for the new PPOR. It would take 11 years for Georgia to exhaust her savings based on existing cash flow. And as you said earlier, Dave, at the end of 2046, at age 74, she could then live off her super, which will have grown significantly, all the while she's debt-free. I think it's an amazing outcome. Mike, what do you think?
I think drinks are on Georgia, to be honest.
Yeah, she's nailed it.
She's galloping across a velvet field on a pig's back. I think it shows the value of the modelling, right? Because let's look at the difference between Georgia today and Georgia at the beginning of the scenario. She was very stressed. She was in a fair amount of financial and psychological stress. But it just goes to show that often that there are ways out of the solution, and Dave has modelled 3 of them, and I think in all of them she's far better off than the situation that she was in. And there's flexibility to do all sorts of different things outside of the plan as well. If she's that in love with Pagewood, she could pay someone to do the maintenance and stay in place. You know, she might be able to arrange for a carer to come and visit. If she wants to stay there in old age, she could take out a reverse mortgage on that property and whittle that down and, you know, destroy the inheritance for whoever's on her next of kin list, you know.
Yeah.
But I think it's amazing to just showcase the power of modelling and planning.
Yeah, agreed. Now, that's sounding a bit gold nuggety to me. And before we get into gold nuggets, for anyone struggling through a tricky decision, it certainly seems like the way to go to untangle the mess and the considerations which might be floating around in the head. And the best way to do that, I think, is effective financial modelling so that you can visualise the outcomes and weigh them up. Probably a great way to move into our gold nuggets. Have you got any final pieces, though, that you want to share with us, Dave?
No, that's been a fun episode to unravel. And, hopefully the preparation notes will be a bit better next time.
No, it's great.
Now it's time for us to go mining for our gold nugget property tip of the day.
I've got one gold nugget. I'm stealing it from you. Personal finance is just that. It's very personal. You're going to make it work for you. I think Georgia's associated guilt feelings and stressing out about things speaks a lot about her conservatism and her willingness to get this right. But she invested for a reason, and that payday came in when she made the decision to sell that St Leonards property for the right reasons and to recoup the benefit that was always intended. So I think well done.
Yeah, look, I talked about the veggies and the dessert metaphor, and there's certainly been a hell of a lot of veggie work in this, but it's just sort of given me sort of pause to rethink that metaphor. I think it's not necessarily about the dessert anymore. She's made the veggies delicious. She's turned what is a cheap counter meal at a local RSL to some sort of glazed Dutch carrots, you know. So that's why I think it's so important to work with someone that can strategically model it out, because the situation from distress to options and flexibility, and I assume a very good spring in Georgia's step, it's wonderful to see.
For me, I really enjoy that plan, and it's a great example for people. I think that, you know, what we've planned there is selling one investment property, only transitioning into retirement, owning one property, which is what most of the population do. And that property actually becomes a home, and then we downsize that home. And so the point is, you don't need to own lots of properties to get benefit out of developing a property plan. And I think that's like one key message from this example.
Agreed.
Gold.
Well, on that note, I'm putting on my Superman outfit and flying to Port Melbourne.
Godspeed.
I will see you guys next week.
See ya.
See you next week.